You thought you were trading price. Candlesticks, indicators, green and red flashes on a screen. It felt logical, scientific, like a game you could master with enough YouTube videos and discipline. But then it happened again. You set your levels, you waited, you entered with confidence, and still the market flipped, took your stop, and left you staring at the screen, whispering, "What did I miss?" You blamed the news. You blamed your strategy. Sometimes you even blamed yourself. But what if I told you you didn't fail because you were wrong? You failed because you never truly saw the game. Beneath every chart, behind every violent move, every fake breakout, every perfect trap, there's something hidden. A skeleton, a structure, a language the market speaks fluently, while retail traders fumble in the dark chasing noise. If you've ever felt like you were close, like you understood the setup, but the market still punished you, then this message is for you. Because once you learn to read what the market is actually saying, not what you want to see, but what's really being written in the structure, trading stops feeling like chaos and starts feeling like clarity. Welcome to the truth behind every move. This is Mastering Market Structure, where we stop guessing and start seeing. You ever feel like the market is messing with you, like it knows what you're about to do before you even click the button? You wake up early, charts open, coffee in hand. You've done your analysis, marked your levels. You even told yourself this time would be different. This time, you're disciplined. Then it happens. The setup appears. Clean break, candle closes strong. You enter. It moves in your favor, just enough to give you hope. Then it reverses violently, hits your stop. And 5 minutes later, the price goes exactly where you thought it would. Without you. Again. And now you're sitting there staring at the screen asking yourself, why does this keep happening? Here's the truth no one tells you. You're not trading price. You're trading your perception of price. And that perception, it's built on illusion. Candlesticks, indicators, EMAs, fib levels, they're all tools, but they're not the market. They're like trying to understand a person by looking at their clothes, not their bones. Because beneath every chart, every pump, every dump, there's a skeleton, a hidden structure. And until you learn to see it, you're not a trader. You're a gambler with a pretty interface. Think about this. Why do professionals win consistently while retail traders get eaten alive? It's not because they have some magical secret. It's because they don't chase the drama. They don't react to the breakout candle. They don't fall for the spike. They see the framework. Structure isn't flashy. It doesn't scream for attention. It doesn't care about your indicators or your strategy. Structure is just there, waiting for you to notice. It's the swing highs and swing lows, the rhythm of expansion and contraction, the heartbeat beneath the market noise. You ever see price break a key level only to reverse hard and leave you stranded on the wrong side? That wasn't a mistake. That wasn't manipulation. That was structure doing its job. Grabbing liquidity, completing a pattern, executing its internal logic while you were focused on the surface. This is the difference between seeing and guessing. Let me paint you a picture. A retail trader opens their chart. BTC is pumping hard. FOMO kicks in. He buys candle, crash. His stop loss gets hit. Again, he blames the market, blames the news, maybe even blames himself. But he never stops to zoom out. If he did, he'd see the truth. That breakout he bought into, it was a liquidity sweep above a recent high, a trap. The final grab before the real move began. Down. The structure was already there. It told the story. Higher low, failed continuation, shift in character. The market wasn't being random. It was speaking. But you have to learn the language to hear it. Structure is not a theory. It's not an advanced concept. It's how every market, forex, crypto, how stocks, breathes. The problem? Most traders are too distracted by tools to see the skeleton. They're reacting to candles when they should be reading context. Let me ask you something. When was the last time you entered a trade based on what the market was showing, not how you were feeling? When was the last time you waited for structure to confirm instead of acting on the first candle that looked exciting? Because here's the hard truth. The market never reverses randomly. It transitions, it shifts. And those shifts, they always happen in structure before they appear in price. That failed breakout, structure saw it coming. That brutal reversal, structure warned you. That range you tried to trade like a trend, structure was whispering, don't do it, but you weren't listening. You were zooming in. changing time frames, doubting your plan. The market wasn't lying, you just didn't speak the language because price doesn't lie, structure doesn't lie. Only your interpretation does. That's why this isn't about finding a perfect strategy. It's about developing your sight. It's about seeing the sequence of swing points, understanding where liquidity is hiding, noticing the change in tempo when buyers step back or when sellers lose steam. Because once you train your eye to see structure, you're not guessing anymore. You're reading, you're decoding, you're responding. You're no longer the one being hunted. You become the one who waits, observes, executes only when the story aligns. And that is how professionals survive this game. Not by being perfect, not by predicting, but by seeing what's already been written. The structure is always there. The question is, are you finally ready to see it? Every trader wants to know where price is going. They ask it every day, up or down, bullish or bearish, should I enter now or wait? But the pros, they're not asking where price is going. They're asking what story it's trying to tell. Because trend, real trend, isn't just direction, it's narrative. It's psychology made visible through structure. It's not just higher highs and higher lows. It's not just red versus green. It's a living sentence, unfolding on the chart, one word at a time. And if you know how to read that sentence, you stop reacting, you start understanding. Let me take you back. Imagine you're watching Ethereum in early 2024. It's been running hot, breakouts everywhere, every dip gets bought, the market feels alive. But then something shifts, a deeper pullback. Not the usual shallow one, this one digs lower. Still, price bounces. You think it's fine, but this time it fails to break the last high. And then, boom, a hard drop. A lower low forms. You weren't ready because your eyes were still looking at the past trend. You were trading the old story while the market had already turned the page, and now you're left behind. This is what kills most traders. They try to trade momentum but ignore the structure that carries it. They think trend is strength, but trend is sequence. It's the relationship between swing points of Strondom, and it's those relationships that reveal the market's true intent. Because a trend is the market whispering, here's who's in control right now. An uptrend says buyers are winning. A downtrend says sellers have taken over. A sideways range says no one has conviction. But here's the problem. Traders don't listen. They guess. They look for confirmation. They wait for indicators to flash. They try to front-run reversals because of feelings or news. Meanwhile, the market has already shifted. It's already begun its transition. Let me show you the signs. A failed high, a break of a significant low, a character shift in volume or pace, a clean CHoCH where you expected continuation. These are not random. They're not accidents, they're warnings. Trend doesn't end with fireworks, it ends with hesitation. And hesitation is always visible if you're paying attention. But most traders aren't. They're still drawing trend lines like it's 2015, still buying the dip because it worked before. Still ignoring the sequence of the market's grammar. That's right, grammar. Because once you see trend as a language, not just a line, you realize something powerful. Every uptrend is a dialogue, every downtrend is a monologue, every range is an argument, and price action, it's just the words used to tell the story. Here's what changed my trading forever. I stopped asking where's price going, and I started asking what phase of structure is this chart in? Is it early in the trend? Is it mid-push with continuation? Is it late-stage distribution disguised as strength, that shift in perspective? It saved me from hundreds of premature entries. It stopped me from buying tops and selling bottoms. It taught me to see trend as a living thing, something that grows, breathes, and eventually dies. But here's the real power. When you learn to read trends structurally, not emotionally, you gain something most traders never will: timing. You stop forcing trades. You start flowing with the market's breath. You know when to follow and when to stand aside. You start spotting reversals before they happen, not after you've been wrecked. You stop chasing the past and begin interpreting the present. Because here's the cruel truth. Indicators wait. Structure acts first. So when the average trader is still wondering if the trend has changed, the professional already knows. They saw the deeper pullback. They saw the failed high. They saw the CHoCH, and they're preparing, not hoping. It's not magic. It's not even hard. It's just clarity. A clarity born from watching how the story unfolds, one swing at a time. So the next time you look at a chart, don't just ask, is it trending? Ask instead, what's the message behind this trend? Who's telling the story? And is the story still true? Because trends aren't just direction, they're conviction, they're doubt, they're crowd psychology on display. And if you can read them, really read them, you'll stop trading based on emotion and start trading based on evidence. You'll stop guessing and start flowing. The market rarely shouts. It doesn't throw up big red flags and sirens when it's about to reverse. There's no flashing sign that says, this is the top or get out now. Instead, it whispers. Subtle changes. A missed high, a deeper low, a single candle that moves just a little too far, just a little too fast. If you're tuned in, you hear it. If you're not, you get blindsided because the market doesn't reward the loudest or the fastest. It rewards the most attuned. And being attuned means recognizing when structure is no longer doing what it used to do, when the pattern breaks. That's where break of structure us and change of character, H, come in. Now, you've probably seen these acronyms all over YouTube and Discords on Twitter. Everyone throws them around like magic formulas. But most traders, they use them as entry signals. They see a BOS and jump in. They spot a CHoCH and assume the reversal is guaranteed. And that's why they keep losing, because they're not listening to what the market is actually saying. They're reacting to a label, not interpreting the message. Let's slow it down. Picture this. You're watching EUR USD on the 4H chart. It's been bullish for weeks. Textbook structure. Higher highs, higher lows. Every pullback has been a gift. Then suddenly the next rally fails to break the last high. Price pulls back deeper than usual. You think, no problem. Just another buying opportunity. You buy. But this time, price slices through the last swing low. Clean. No hesitation. That's your first signal. Break of structure. The market has violated its own logic, and if you're paying attention, you feel it. Something's changed. But here's where most traders go wrong. They see the BOS and assume reversal is happening now. So they flip, sell aggressively, but the market bounces, reclaims the broken level, keeps going higher. They're confused, angry, trapped, because what they thought was a reversal was just a liquidity trap. This is where change of character becomes your decoder ring. BOS tells you structure was just broken. CHoCH tells you the behavior of the market has shifted. It's the difference between a market taking a breath and a market turning its back. A CHoCH is when the first lower high forms in an uptrend or the first higher low in a downtrend. It's the first violation of narrative, the first real sign that the story is no longer continuing. It's resisting itself. That's powerful. But let me show you where it gets even deeper and more dangerous. Because structure doesn't always tell the truth. Sometimes it lies. You see a clean BOS. You enter, but instead of continuing, price wicks hard and reverses. You're trapped. Again. What happened? The market used structure as bait. That BOS? It wasn't a continuation, it was a fake out. A liquidity grab dressed up as structure. This is where most traders lose their edge. They start doubting structure entirely. They say this stuff doesn't work, but it does. They're just not seeing the context. Because a BOS without follow-through is not a break, it's a test. A CHoCH without volume is not conviction, it's a whisper. Let's break this down. 3 signs that structure might be lying. Lack of follow-through. The break happens, but price stalls. No momentum, no push. Aggressive rejection, fast wick reversals, or engulfing candles right after the break. Liquidity context. The break occurs into equal highs or clean lows, places where stops are obvious. When you see all 3, pause, watch. Don't commit yet, because smart traders, they don't trigger off structure. They filter with it. They don't assume BOS means entry. They observe how the market behaves after the break. Is there strength, volume, momentum, or is it hesitation? Rejection? Traps? Here's the golden insight. A true shift in structure reveals itself through the retest. After the CHoCH, after the BOS, after the sweep, that's when the new structure proves itself. That's where conviction lives. That's where asymmetric opportunity appears. And if you don't see a retest, if price flies without you, let it go. Because chasing a lie is far more expensive than missing a move. Let me ask you something, and be honest. How many times have you held on to a losing position because you hoped structure would come back? How many times did you exit a winning trade because you feared a fake out that never came? These aren't just trading mistakes, they're emotional blind spots. But structure, real structure, can guide you out. You just have to listen closely because the market doesn't lie. It simply speaks in layers. And once you can read those layers, you'll stop reacting to every move. You'll start responding with precision. So next time you see structure break, ask yourself, is this the market telling me the story has changed? Or is this the market setting a trap and I'm the bait? Because once you master the truth and the lies that structure tells, you stop being a victim of price. You become a reader of intention. And that's when trading stops being luck and starts becoming mastery. You thought you were the player. You studied the charts. You waited for confirmation. You planned your trade and executed it with care. But the moment you entered, the market reversed again. And in that moment, it didn't just take your money. It took your confidence, your logic, your peace. You stared at the screen, thought, why does this keep happening right after I enter? Let me give you the uncomfortable truth. You're not the player. You're the liquidity. Because the market, the real market, doesn't move to reward precision. It doesn't care about your perfect entry, your tight stop, or your well-reasoned thesis. It moves to find liquidity. And your stop loss, that's the feast. Let's strip this down. Every time you place a trade, you do two things. You enter with intention. You expose your exit, your stop loss. That stop, that's an order. That's liquidity. And to the players who actually move this market, that's not a defensive wall. That's a target. You think the market is trying to go up or go down, but that's not what it's doing. The market isn't trying to go anywhere. It's trying to go to someone. Specifically, the traders who are most exposed, most certain they're right, and often that someone is you. Let me show you how it plays out. You spot resistance. Price tapped it twice, clean. You go short on the third touch. Everyone sees it, triple top. But price breaks above, your stop gets hit. You curse. Then price collapses. Hard. You were right. And you still lost. That wasn't random. That wasn't manipulation. That was liquidity harvesting. Because smart money needs fuel to enter. They can't just market buy with a $50 million position. They'd move the market against themselves. So what do? They engineer liquidity. They drive price into obvious stop zones, above recent highs, below clean lows, anywhere traders cluster with tight stops. Then, and only then, they enter. Not before, not after. Exactly when your confidence peaks and your protection is exposed. It's not evil, it's structural. Think about it. If you were trying to build a massive long position, wouldn't it be efficient to trigger every retail short first? To drive price into a fake breakout, let everyone pile in, and then reverse hard using their exits as your entry? That's not manipulation. That's just strategy. And here's where it gets even deeper. Because liquidity creates structure. That CHoCH you saw, it wasn't just a reversal. It was a trap that cleared out weak hands before the real move began. That failed BOS, it wasn't a failed trade. It was a liquidity sweep disguised as a breakout. Liquidity and structure are not separate. They're married. You can't read one without understanding the other. Let me ask you this. Have you ever noticed how often price hits your stop by a few pips, then rockets in your original direction? That's not coincidence. That's architecture. Because your stop loss doesn't just represent your protection. It represents your fear and your predictability. And smart money trades against predictability. They don't chase price. They trap it. They don't react to breakouts. They create them to catch the crowd. The breakout you're buying, they're selling into it. The support you're shorting, they're accumulating under it. Let's make this real. Take Bitcoin in 2017. Price pushes to 20K. Headlines explode. Social media screams 100K next. Retail floods in, euphoria everywhere. Then one final wick, a sweep just above $20, and the crash begins. That wasn't a coincidence. That was liquidity execution at a psychological level. Because even at the macro scale, stop losses fuel moves. And now here's your shift. Stop seeing your stop loss as a safety net. Start seeing it as your greatest vulnerability. That doesn't mean don't use stops. It means place them with intent. Put them where the market won't hunt them, where liquidity has already been swept, where you're not sitting in the open, naked and obvious. Smart traders don't place stops at the swing low. They place them beyond it, not in the cluster, but behind the trap. They don't buy clean setups. They buy after the sweep. They don't short clean breakdowns. They short after the fake pump because they understand this. Liquidity isn't just horizontal, it's psychological, it's emotional. Your panic exit, that's liquidity. Your FOMO entry, liquidity. It has to go now trade, liquidity, served cold. And that's why your job is not to avoid liquidity, it's to trade with it. You stop entering when it feels safe and start entering where it feels uncomfortable. But right, because when everyone else is trapped, that's your moment of freedom. And now take this with you. The next time you see a clean level, don't ask, is this support or resistance? Ask instead, who's trapped here? Who's exposed? Who just lost control? Because that's not where the price is going. That's where the opportunity lives. You saw the setup, textbook CHoCH, liquidity swept, candle closed strong, you entered, you were sure. Then it stalled, chopped sideways, reverse, stopped out, and then, like a cruel joke, price moved in the direction you originally anticipated. But without you, you sit there, frustrated, confused, asking the same question every trader eventually whispers, what did I miss? Here's the answer. You weren't wrong. You were incomplete because you were only reading one page of a book being written across multiple chapters. That's what multi-time frame structure is. Not just a higher time frame versus lower time frame, but a layered narrative, unfolding at different speeds. You see, the market is fractal. It tells the same story again and again, but at different scales, like Russian dolls or the zoom-in scene in a movie. The closer you get, the more detail you see. But if you forget the big picture, you misread the plot. Let me show you how this destroys traders. Imagine you're on the 15-minute chart. You see a bullish CHoCH, volume picks up, you buy. It looks perfect. But what you didn't see, the 4-hour chart is in a confirmed downtrend. And your beautiful M15 setup, it's just a bearish retracement into an H4 supply zone. You weren't wrong on structure, you just missed the context. And in trading, context is everything. Would you open an umbrella because a breeze blew past? Or would you check the forecast? Most traders don't. They see a candle form and act like it's the entire truth. They're playing checkers on a chessboard. But pros, they ask better questions. What's the dominant structure on the higher time frame? Is this lower time frame move in alignment or in opposition to it? Is this a real setup or just noise? Let me give you the structure of how professionals stack time frames. Anchor your bias on the higher time frame, usually the daily or H4. Drop down to the M15 or M5 for entries. Look for alignment. If HTF is bullish, LTF should show CHoCH plus BOS plus liquidity sweep in the same direction. This is multi-time frame confluence. It's like aiming a sniper rifle through 3 lenses, not just one. The higher time frame gives you direction, the lower gives you precision. And when they align, the trade doesn't just look good, it feels inevitable. Here's what most don't realize. Each time frame is a different character in the market. The M1 and M5, they're noise traders. Bots, retail chasing every tick. The H1 and H4, those are your swing traders and institutions. The daily and weekly, that's where campaigns are built. When you enter on the M15, you're stepping into a conversation already in progress. If you don't know what the daily is saying, you're speaking out of turn. Let me make it painfully real. You short Bitcoin on the M5, clean CHoCH, volume spike. Looks great, but the daily just swept liquidity below a major low and is forming a strong bullish engulfing candle. What happens? Your short gets squeezed, your thesis explodes, and you're left wondering how something so perfect could fail. The truth? It didn't fail. You just didn't zoom out. Because structure exists on every time frame, but edge lives where they align. Let's define that clearly. A clean M5 setup against H4 structure is a gamble. A clean M5 setup with H4 structure is precision. When you understand this, your entries change. Your patience increases, your losses decrease, because you're no longer forcing your trades into bad locations. You're waiting for confluence, you're stacking your edge, and suddenly the market starts making sense. You see the trap before it happens. You recognize the retrace not as a trend, but as a pullback. You don't just see price move, you understand why it's moving. You see the story. Let's zoom out even more. Every time frame carries different emotions. M1 shows panic, H1 shows fear, daily shows conviction, weekly shows legacy plays. When you know which time frame the market is operating on, you know who's in control. You stop trading against institutions without realizing it. You stop entering too early because you confused a pullback with a reversal. You stop guessing. And this is the shift that separates the amateur from the professional because the trap wasn't in the price, it was in your perspective. So the next time you're about to hit that buy or sell button, ask what story is the higher time frame telling? Is this setup part of the narrative or a footnote? Because if you can't see the market in layers, you'll keep falling for single frame lies. But when you stack timeframes, you see depth, you see flow, you see opportunity, and most of all, you see the truth behind every move. You had the perfect setup. CHoCH confirmed. Liquidity swept, timeframes aligned. Even your gut said, this is the one. You entered, and price did nothing. Chopped sideways, stalled, wasted hours of your life. Then, when you finally gave up, price exploded in your original direction. And just like that, you were right and still lost. Why? Because you were early. And in trading, early is the same as wrong. You see, most traders obsess over the where. Where is support? Where's the order block? Where should I enter? But they ignore the when. And that's like trying to surf a wave before it forms. You paddle hard, you stand up, and the water isn't there to catch you. Because in this game, timing isn't optional, it's everything. Let me reframe the market for you. It's not just charts and patterns, it's a performance, a theater. The same pattern, the same structure plays out every day, but it hits differently depending on when it happens. A bullish CHoCH at 2 a.m., that's noise. The same CHoCH at London Open, that's intention. Because the players are different, the volume is different, the energy is alive. Let me walk you through the rhythm of the day. Asia session, Tokyo, quiet, controlled, a range building phase, smart money rests, liquidity consolidates. London session, Europe, the break, the trap. This is when false moves form, the Judas swing. Market fakes one way only to snap the other. New York session, the follow through, the expansion. This is where the real move often happens, or the complete reversal that traps those who traded London's lie. If you don't know what session you're trading without a clock. And when you're out of sync with time, you confuse setups for randomness. Let me give you a painful example. A trader sees a beautiful short setup on EUR USD. Perfect structure. Liquidity swept, momentum dying. He enters during New York lunch hour, a dead zone. Low volume, no commitment, price grinds sideways. He loses patience, exits. An hour later, price dumps. The setup wasn't bad, the structure wasn't wrong, but the timing was garbage. Here's what most don't realize. The market doesn't just breathe in price, it breathes in sessions. Asia inhales, building the range. London exhales, breaking it. New York decides continuation or reversal. Pros know this. They don't just look for structure, they wait for the clock. Most of their trades executed 15 to 30 minutes after session open. Why? Because that's when volume activates. It's when traps are clearest, when stop hunts begin, and more importantly, when smart money shows its hand. Let me drop a bomb on your psychology. You keep losing not because you're wrong, but because you're too early, too impatient, too unaware of the market's rhythm. Timing also goes beyond the day. It moves in weekly patterns too. Monday, range creation, fake moves, market setting the stage. Tuesday, Wednesday, expansion, direction reveals itself. Thursday, momentum, this is the real move. Friday, trap exits, positioning, liquidity plays before close. If you trade big on a Monday morning without clarity from higher timeframes, you're gambling. If you chase a move on Friday afternoon, you're likely fueling the opposite side. That's not discipline. That's self-sabotage with a nice excuse. Here's what the pros do. They don't trade every session. They know when their edge is most alive. Some only trade New York Open. Some wait for specific news hours. Some trade once a week, but with perfect timing. Because they understand this truth. A B plus setup at A plus timing beats an A plus setup at C timing every single time. They build playbooks not just around price, but around time. They timestamp their setups. They track which times of day their edge shows up. They don't just trade structure, they trade structure within time. Let's bring this down to you. If your strategy works great at London Open, but fails at Asia session, that's not randomness. That's a time-dependent edge. Track it. If choches during low volume fail more often, stop taking them. If liquidity sweeps happen most often at 8:30 a.m. EST, wait for them. You're not trading setups, you're trading behavior. And behavior is always tied to time. Let me wrap this with something powerful. There's a concept called the Judas swing. It's a fake move during the first hour of a session, especially London, designed to trap early traders. It shows up almost like clockwork, and once you start seeing it, you can't unsee it. You'll watch the market bait traders into a direction, only to reverse and leave them gasping. You don't want to be that guy. The one who entered too early, too excited, too emotional. You want to be the one who waits, watches. Let's time confirm what structure suggests, because trading isn't just about where the setup is. It's about when the market is finally ready to make the move. And the trader who understands both becomes deadly. Markets aren't made of charts. They're made of people. And people are made of fear, greed, hope, panic, ego, and desperation. Every swing high, that's hope. Every stop loss, that's fear. Every breakout, that's a rush of belief that this time it's real. But it never is. Because sentiment is the most deceptive force in trading, and the most powerful edge if you know how to see through it. You felt it. You saw Bitcoin pumping, everyone on Twitter screaming, next stop 100K. You bought in, not because the structure confirmed, but because the crowd made you believe. And 2 weeks later, price was down 30%. You didn't just lose money, you lost trust in yourself. That's sentiment. It's the invisible current running underneath every market move. And when the crowd believes too much, that's usually when smart money cashes out. Because here's what the masses don't realize. The louder the market screams certainty, the closer we are to a reversal. Let me paint you a picture. Imagine Solana in early 2023. Dead, forgotten, ranging, sentiment, pure despair. People called it a scam, a zombie coin, going to zero. Then one day, it fakes a breakdown, wicks below range lows, everyone capitulates. That's when it reverses, reclaims the level, breaks a clean internal structure, and suddenly, the trend is no longer down. That wasn't just a move, that was a market structure shift fueled by sentiment exhaustion. Because the market isn't just looking for liquidity, it's hunting emotions. Think about this. When everyone is long, there's no one left to buy. When everyone is short, the fuel for a rally is fully loaded. And the pros, they fade the crowd. Not recklessly, not emotionally, structurally. They map the order flow. They identify key sentiment zones where traders are most committed, and they wait for the final emotional spike, for the I can't take it anymore candle, for the moment of maximum conviction right before the turn. That's when they strike. You've seen this over and over, but now you'll finally understand what's behind it. Let's break this down. A true market sentiment shift has 3 ingredients: liquidity, event price sweeps an obvious level, takes out emotional participants, everyone reacts. Structure break, CHoCH or BOS appears after the sweep, not before, after. That's the key. The market declares that wasn't continuation, that was a trap. Volume plus intentional follow through. The move isn't hesitant, it breaks structure with conviction. The story has changed, and price knows it. This is when opportunity is born, not in randomness, but in psychological imbalance. Here's the paradox. The best trades happen when structure and sentiment disagree. When the chart shows a higher low, but everyone is bearish. When a clean BOS forms, but headlines scream collapse. When the market says buyers are stepping in, but the crowd still believes it's a bull trap. That disagreement, that's your edge, because one of them is lying, and it's usually the crowd. Let me ask you, how many times have you chased a move just because everyone was talking about it? How often did you panic, exit a winning position because sentiment suddenly flipped against you? These aren't random mistakes. They're sentiment-driven sabotage. And if you don't manage this force, it will manage you. Here's how to reverse it. Before every trade, pause and ask, what is the crowd feeling right now? What are they expecting? Am I trading the chart or the emotion of the moment? If your trade aligns with the obvious crowd narrative, reconsider. If your trade fades the crowd and aligns with clean structure, now you're onto something. And if sentiment confirms structure, that's your strongest setup. Here's a powerful pattern. A clean CHoCH forms. Retail doesn't believe it. Sentiment stays bearish, even as price builds higher lows. That's a silent accumulation. And when the breakout comes, it explodes because crowd was wrong again. Remember, you're not trading setups, you're trading human behavior. And human behavior is predictable when people are under pressure. So start tracking sentiment like you track price. Use volume spikes. Track social media. Look at candle bodies, big wicks, emotional rejection, news, often the trigger for the trap. And most importantly, stay detached because the market doesn't reward emotion. It punishes it. It doesn't care how much you believe. It only cares about who's trapped next. Your job is simple: map structure, overlay sentiment, identify where the two are about to collide, because at that collision point comes clarity, comes opportunity, comes control. And the trader who sees both, he doesn't just survive the crowd, he trades against it and wins. Every candle on the chart has two stories behind it. One is a trader who risked too much too soon and got wiped out. The other, a trader who survived, who walked away with a small loss, who lived to fight another day. Same setup, same price action, different outcomes. What made the difference? Risk management. Not the kind you write in a journal and ignore in real time. Not the kind you say you'll follow next time, but the kind that becomes your instinct. The kind that decides whether you evolve in this game or become extinct. Let me tell you something uncomfortable. Open quote. You don't win in trading by being right. You win by staying alive long enough for your edge to matter. Close quote. That's it. Every trader gets hot. Every trader gets cold, but only the adaptable stay in the game. Now imagine this. You spot the setup. Everything aligns: liquidity, CHoCH, timing, sentiment. You size up because this is the one. You enter. The market flicks against you. News drops, spread spikes, one flash move, your stop is gone. And now, you're not just out of the trade, you're emotionally compromised. You want it back. You double down on the next setup. It fails. You enter again, bigger. Now it's not about structure, it's about revenge. And just like that, you've given back a month of progress in a single afternoon. Not because your edge was bad, because your risk system was broken. Here's what the best traders know. Open quote, trading is not about protecting your wins. It's about preserving your ability to keep trading. Close quote. They don't risk 10%. They don't even risk 5%. They risk 1 to 2% max per trade. And even that, they adjust depending on the environment. Risk is not static. It's adaptive. The best traders change their size like you change your gear in a storm. Choppy market, smaller size, wider stop, lighter stops, less exposure. Clean trending conditions, normal risk. Standard playbook. Newsweek, micro size, or no trade at all. They're not rigid. They're responsive because they know the same setup that printed perfectly last week might fail miserably this week. Not because of them, but because the market changed. Remember the crypto bull run of 2020, 2021? Everything worked. Breakouts followed through. Dips were bought. Momentum was real. Now think about 2022. Same setup, same strategies, but now CHoCHs failed. Sweeps went deeper. Breakouts became traps. What changed? The market's personality, and the traders who failed to evolve bled, slowly, quietly, consistently, because they were trying to force yesterday's playbook into today's market. That's not strategy. That's self-delusion. The three-step adaptive risk framework. 1. Categorize conditions: trending, ranging, volatile, quiet. 2. Assign risk rules: trending, full 1%, ranging, half risk, volatile, reduced exposure. Newsweek, optional, or sit out. 3. Review performance by condition. You might find you excel in breakouts, but consistently lose in chop. That's data, that's edge. Trade bigger when the market favors you. Trade smaller, or not at all, when it doesn't. This is how you survive. This is how you adapt. But survival isn't just about position sizing. It's about knowing when to stop. Let me ask you, do you keep trading after 3 losses in a row? Do you revenge trade to win back the day? Do you feel like quitting after a drawdown? If the answer is yes, you're human, but you're also vulnerable because the market doesn't care about your emotions. It only cares about your exposure. And if you keep showing up to battle with no armor, eventually you'll be taken out. Here's what high-level traders do. They set daily loss limits. They limit trades per session. They walk away when the environment turns ugly. They journal not just trades, but state of mind, because emotional risk is as real as monetary risk. And when you don't account for it, that's when you lose control. Here's something else they know. Structure gives you your stop. Context gives you your size. Self-awareness gives you your edge. If you enter on a CHoCH after a liquidity sweep, your stop goes below the sweep. Simple. But how much you risk, that depends on the quality of the environment, your mental clarity, your last few trades, the session you're in, and whether you're trading with or against higher time frame structure. This is risk management at the professional level. It's not just math, it's mindset. Because in this game, open quote, you're not fighting the market, you're fighting the urge to overexpose yourself in search of certainty. Close quote. But certainty doesn't exist. Only control does. And control comes from building a system that protects you from yourself. So ask yourself, do I adapt my risk to the environment? Do I know when to walk away? Am I building for the next 10 trades or just trying to win the next one? Because the market will always evolve. And if you don't evolve with it, you're done. You've done the work. You studied structure, you mastered liquidity, you timed your entry, you sized your position with precision. But then, in the moment, you hesitated. Price tapped your level. It was everything you waited for. And yet, your finger froze. Your brain whispered, what if it fails? And by the time you gathered the courage, it was gone. The move took off. Without you. Frustrated, you chased the next candle. Forced a late entry. It reversed. Stopped you out. And you sat there staring at the screen, wondering, why do I keep doing this to myself? Here's the truth no one wants to hear. Open quote. Most traders don't lose to the market. They lose to their mind. Close quote. Because structure is objective, but your emotions, they're loud, they're fast, and they're always looking for control. Fear, greed, impatience, self-doubt. These aren't just feelings, they're the invisible traders sitting next to you. They click the mouse before your logic gets a say. Let me show you what this looks like. You see a perfect setup. Liquidity has been swept. Timeframes are aligned. You've waited for days for this exact confluence. Price approaches your entry. Then it begins. What if it wicks and reverses? Maybe I should wait for one more candle. What if news is coming? What if this is the fake out? Your heart rate climbs, your breathing shifts. You don't enter. Then price explodes in your direction. And now you're not thinking, you're reacting. You FOMO in late. No structure, no plan, just emotion. And like clockwork, the market punishes you. Not for being wrong, but for being emotional. This is the inner game, and mastering it is the difference between short-term noise and long-term mastery. Let's break it down. Most traders think psychology is about feeling confident. It's not. Open quote, it's about taking the right action, even when you feel uncertain. Close quote, because you'll never fully silence the voice of fear or kill off greed entirely, but you can anchor to structure when emotions rise. 3-step inner game framework. 1. Journal the emotion, not just the trade. After each trade, don't just note the entry and exit. Write, what was I feeling before I entered? Was I present or reactive? Did I follow my process or chase the feeling? This isn't for punishment. It's for awareness, and awareness is where change begins. 2. Visualize the execution. Olympic athletes don't just train their bodies. They rehearse the moment over and over in their minds. You need to do the same. Before the trade comes, picture price tapping your zone, you entering without hesitation, you exiting with discipline, win or lose. This creates emotional muscle memory. So when the real moment arrives, it feels familiar, controlled, neutral. 3, create a ritual that grounds you. Maybe it's 3 deep breaths, maybe it's reviewing your rules aloud, maybe it's a specific playlist. Whatever it is, make it a pre-trade ritual. Because consistency in preparation leads to consistency in execution. And in trading, open quote, consistency is your edge, close quote. Here's something powerful I use. Whenever I feel that emotional surge, the need to chase or the fear to act, I pause and I say out loud, what does structure say? That one sentence breaks the pattern. It snaps me out of emotion and back into process. Try it. Seriously, because over time you'll learn something profound. Open quote. Your emotions aren't enemies, they're data. Close quote. Fear, it means you're stepping into uncertainty. Maybe you're risking too much. Greed, it means your ego wants control. Maybe your self-worth is tied to the result. Doubt, it means you haven't built enough repetition. Maybe you haven't proven your edge to yourself. This is how you build unshakable psychology, not by suppressing the feeling, but by listening to it without obeying it. That's emotional maturity. That's trader growth. Let me ask you, do you know what triggers you? Do you have a rule for when to walk away? Do you know how your state impacts your execution? Because the pros do. Some only trade 2 setups. Some only trade the first 2 hours of a session. So leider had style. Some have rules like 2 losses and I'm done for the day. Not because they're weak, but because they're self-aware. And in this game, open quote, self-awareness is more powerful than prediction, close quote, because no setup is perfect. But if you can execute with clarity, with neutrality every time, you don't need perfection, you need presence. Let me leave you with this. Open quote, structure is the map, psychology is the vehicle, and your process is the driver. Close quote. If your emotions hijack the wheel, even the best roadmap leads to a cliff. But when you stay in the driver's seat, calm, grounded, focused, that's when trading becomes precision. So the next time you hesitate or panic or second guess yourself, don't fight the feeling. Just ask, what does structure say? And let your process lead the way. So you've made it. You've walked through the deep end. Structure, liquidity, timing, psychology. You've seen how the market truly moves, not randomly, not emotionally, but with intention and patterns that repeat like clockwork if you know how to see them. Now comes the part no one likes to hear. Knowing it isn't enough because understanding structure is not the same as executing it. Memorizing CHoCH and BOS doesn't make you a trader. Open quote, mastery is not a result of learning, it's a result of repetition. Close quote. Let me show you what that looks like. You open your chart, you see a setup, your brain floods with insights. That's a sweep, that's a CHoCH. This looks like a Judas move into NY Open, but now your hands shake, you hesitate, because there's a gap between what you know and what you can trust under pressure. That gap, open quote, it's where 99% of traders fall apart, close quote. And the only way to close it, deliberate practice. Not blind back testing, not clicking replay for dopamine hits, but true structured review. Let me give you your first assignment. Tonight, open your charts. Pick a pair, any pair. Go back 3 months, find 5 clean CHoCH setups. Screenshot each one. Write down, where was liquidity? What session was this? What happened after? Did volume follow through? What did the higher time frame say? Do this for 30 minutes. That's it. Because mastery is built in minutes, stacked over months. You don't need another course. You don't need more indicators. You need time with the chart. You need to build a memory bank of structure in motion. That's how pros do it. They don't look at setups to be impressed. They study why it worked or why it failed, and they log it. They don't journal like a diary. They journal like a detective building a case file. Every trade, every hesitation, every moment they broke or followed their process. Why? Because reflection creates pattern recognition, and pattern recognition creates conviction. And conviction, open quote, that's what lets you pull the trigger without panic, close quote. But here's the part that separates the committed from the casual. Open quote, they don't reflect once, they reflect forever, close quote. Every month they ask, has the market changed? Are sweeps deeper now? Is volatility higher or lower? Which sessions favor my edge? They evolve constantly, because here's the brutal truth. Open quote, the market doesn't care about your system. It doesn't care what worked last year. It only rewards those who can respond to now, close quote. And to do that, you need more than theory. You need ritual. Daily chart review, weekly journaling, monthly reflection. This is how you move from student to operator. And the transformation, it's not flashy, it's quiet, slow, internal. You won't notice it in the moment, but one day you'll enter a trade without fear, without FOMO, without second guessing. Not because you're confident, but because you're clear. You've seen this setup 20 times. You've studied the structure, you've tracked the sentiment, you've tested the timing, you've risked what's appropriate, and now you act. That's not luck. Open quote, that's earned. Close quote. Let me ask you something real. What if you stopped chasing wins and started chasing clarity? What if every loss became data, not defeat? What if you stopped saying this setup failed and started asking, what did this setup reveal? That's the shift. Open quote, from reaction to reflection, from trying to win the market to partnering with it, close quote. Because at the highest level, you're not here to predict. You're here to respond. To be so in tune with market structure that your trades feel inevitable. To be so aligned with your process that emotions don't shake you. To be so adaptable that no environment can knock you out of the game. That's the path forward, and it's not easy, but it is clear. Every day you practice seeing structure. Every trade you practice discipline. Every loss you practice learning. Every win you practice humility, because the market is the ultimate teacher. Open quote. But only if you show up as the eternal student. Close quote. Let me leave you with this. Open quote. You don't need to be perfect. You just need to be present. You need to be structured. You need to be consistent. Close quote. That's the trader you're becoming. So ask yourself one final question. Who am I becoming through this process? Right now, go pull up your last 5 trades. Look at the structure before each one. Was the CHoCH clean? Was the BOS real? Write one sentence per trade. Here's where I honored structure. Here's where I ignored it. Don't judge. Just become aware. Because awareness, open quote, that's where transformation begins. Close quote. And transformation, open quote, that's where your edge lives. Close quote. Now get back.